Hello everyone, and welcome to the next video in our interview question review series. Today we're going to review the concepts of enterprise value and equity value. In interviews, you'll often be asked what each of these concepts mean and how you can work from one to the other. We'll cover all of that here. I should note that in particular, enterprise value is often very confusing for folks because it's taught in a very confusing way. We're going to aim to clarify any confusion you have here, and I promise if you invest a little bit of time, you'll be far more effective in your interviews and on the job. With that, let's hop in. The first thing I want to note is that a house is a business. So I'm going to make the case here that these two things are the same. And the reason for that is the overarching goal of a business is to collect cash from customers. And a house, when we rent it out, is the exact same thing, but our customers are our renters. They pay us. Now, let's imagine that instead of looking at this as a house and a business as two separate things, since they are the same, we're going to think of them as just boxes of value. So I'm going to tweak the presentation here a little bit. We'll get rid of the house. And let's just think of these as two different equivalent boxes of value. Now, let's also imagine that we wanted to purchase the house in particular for $100,000. So to buy this house, we'd have to pay the sellers $100,000 out of our own pocket. And that price that we pay the sellers, we would call purchase price. If we were to buy a business, it would be the exact same thing. Let's imagine that we're buying a business for $100,000. But instead of calling it purchase price, we have a fancy term for this in the finance world called enterprise value, or EV. So in the end, it's the exact same thing for both a house and a business. We just use a slightly different term. And the term enterprise value really just means how much would we pay to buy the entire asset as opposed to a particular component of the asset. The next thing to note here is that the term enterprise value is often referred to as an unlevered value. So levered is leverage, leverage is debt. They're all roughly equivalent terms. And the reason that enterprise value is referred to as an unlevered value is that it's independent of the funding of the business. So for example, let's imagine for both we're going to draw D for debt and E for equity. Let's imagine for a second that we purchased the house with 50 of debt and 50 of equity, same thing with the business. Or alternatively, we purchase both with 80 of debt and 20 of equity. It really doesn't make a difference how the business or the house is funded because we have to pay $100,000 no matter what. So that's why this is referred to as an unlevered value, is because the valuation is independent of the debt and equity. And in finance, the term is sort of the debt and equity together are referred to as the capital structure. So what we're going to do now is work from the purchase price down to what the owner owns, which is what we refer to as equity value. So let's again imagine that we purchased both of these assets, and we'll say, just to keep this simple, we purchased them for 50-50 debt and equity. If we wanted to look at the equity value that we would have as the owner of either of these assets, it would be $50. But it's not because we invested, let's just change the color here, it's not because we invested $50, it's because if we were to go and resell either of these assets to someone else, we would have to pay off the mortgage before we could collect anything. So let's actually just demo this with the house. So if we were to sell the house, let's actually get rid of the debt and equity for a second. If we were to sell the house, again, we would collect $100,000. But before we get anything, to make this point clear, hopefully, we would have to pay our lenders $50,000, and we get whatever's left over, which in this case would be another $50. So equity value is really just the value that sits beyond the debt once we've paid off our debt. And as we'll see in a second, there's actually a little more to this than just the ownership in the underlying asset, and that's cash. So we'll come back to that in just a second. All right, now before we move ahead, I'm going to move this down a little bit, and I'm going to draw out a formula so we can actually work to equity value numerically here. Oop, went a little too far. So we're going to say that equity value equals something, and we're going to work to that something. So going back to the example we just went through, to get to our equity value, and I'm actually going to erase the equal sign here real quick. To get to our equity value, we would take the sale price or the enterprise value, and we'll actually demo this with both the business and the house side by side. So let's just do it for both. And we would have to subtract debt. So the debt would be 50 in each case. And again, what we would have left over is $50 of value. Now, as I said, there's a little more to the equity value picture than what I've showed you thus far, and that's cash. So let's imagine attached to each of these items is a bank account. We'll just write bank here for both. And let's imagine that we've collected $10 of cash from renting out the house, or $10 of cash from selling things to customers. As the owner of either the house or the business, we own both of these things, as well as the underlying equity in either the house or business. So our equity value is really the combination of the equity in the asset as well as the cash that we own. So that's the last piece here, is we have to add cash to the formula. So we're going to add cash. And in this case, our equity value would be, we'll just draw it out in the formula itself, would be $100,000. $100,000 minus the 50 of debt plus the 10 of equity, or 10 of cash, sorry, would give us equity value of 60. And really what that is just the 50 and the 10, the value in the underlying asset, as well as the cash that we have accumulated. So we've worked the equity value, and now I'd like to show you how we can work from equity value to enterprise value. So let me get rid of some of the details here. And what we'll do is move this down, and we're going to get rid of our numbers, and we're going to draw the formula, but in a slightly different way. So we're going to start with enterprise value equals. So enterprise value equals is where we're going to start, and we're going to work to enterprise value from our equity value. Now remember that equity value includes both cash and the underlying equity in the asset. So let me actually move this over just a little bit here. So equity value, as I said, is really the underlying equity in the asset as well as the cash that we own. We're going to demonstrate how you would go from equity value to enterprise value now, really focusing on the house, and then I'll demo it with the business. So let's start with the house here. So with the house, we would start with, just to show this visually, we'd actually start with equity value, which, as we said, is $50 of underlying equity and $10 in the bank. And let's imagine that we know that this house has on it $50 of debt. Let's make a note of that. Okay? Well, if someone said, what is this house worth? You'd start with the $60 as the owner, and you'd say, okay, well, to begin with, this $10 of value that I own in cash, that's mine. So if I were to ever sell the house, and the same applies to a business, that comes with me. That doesn't go with whoever I'm selling the house to. So I'm left with $50 here. The $50 reflects all of the value of the asset that exists after debt is paid off. So the next thing to note here is that the only way we ever have equity value, whether it's in a house or a business, is if there's value beyond the debt. And so acknowledging that is important, because we have to say, okay, well, if we have $50 of equity value, what we really need to do is add debt to the picture, because there would be no equity value if there weren't any value beyond the debt. In this case, we have $50 of debt. And at that point, we've now worked to the value of the underlying asset. And it's almost like the capital structure, the debt and equity, disappear. So once we get to that point, we've really just calculated the value of the house. It's just a function of our starting point that we had to work from the equity value to this. But once we get to this point, there's really nothing left but the value of the underlying house, which would be, again, like the list price or the purchase price of a house. just to follow that, and I'm actually going to work through the formula this next time with the business, it's the same exact flow. So with a business, we'd start with the $60 of equity value here, and I'm going to use numbers this time around. And from that $60, we could work to the value of the business. So the first thing we do is we would get rid of our cash. So let's get that out of the picture here. And we would subtract cash. And then what we would do is we would add debt. Now in the picture, it's already done for us, so it's already set up here. But you would next add debt to the equity that you have. And again, once you get to that point, it's almost as if the entire capital structure disappears and you get to the enterprise value, which is the price you would pay to buy the entire business. So to punch that in our formula, we would subtract cash of 10. We would add debt of 50. And that would get us to an enterprise value of 100. So to wrap things up here, we're really dealing with two concepts: enterprise value, which is the value to buy the entire asset, whether it's a business or a house, and then equity value, which is what the owner owns, which is really the underlying equity in the asset itself, as well as any excess cash that's accumulated at a given point in time. So those are the concepts of enterprise value and equity value. Hopefully this makes a little bit more sense now. Stay tuned for more of our videos. We're gonna have a lot more coming, where we'll walk through investment banking, private equity, hedge fund interview questions, and hopefully bring some clarity to you all as you go through your interview process. So thanks so much, guys, and talk soon.